Hello, everyone, and welcome to another episode of Financial Tides. Today, we're going to be talking about the economy, recession, and what our outlook is moving forward. So, take it away to start with my co-host here, John.
Hello, everyone. So we're almost halfway through the fourth quarter here. And, the big questions we get are optimism and discussion of what 2024 looks like. And, things are very spread out right now. Like a few weeks ago, we said, all right, everything's down now for 2 months in a row. And then now we're coming out, we're recording mid-November, and we've had like 10 out of 11 up days or 9 out of 10 up days, over the last couple of weeks. So, things are starting to look a little more normal and robust, but there's pockets of value, and there's pockets of overpriced stuff. So, it's a good time to be careful, and it's a good time to be diversified. And as the guys that will tell you that, we have no idea what the next thing's going to rally, we would tell you to own everything. And by owning everything, you'll always come out on top.
Yeah, kind of along the lines of those pockets, John. You haven't mentioned anything about the Magnificent Seven yet. So, tell us a little bit about the Magnificent Seven and how that kind of affects those pockets.
Yeah, it's getting, if you're watching financial news, you're hearing this already, and I apologize for the redundancy. But if you're not watching financial news, there's 7 stocks out there that are carrying the torch for the entire market. I mean, 7 of those stocks have made up like 25% of the S&P's return year to date. It's absolutely crazy. And so what do people want to do? They want to take everything out of things that have been paying dividends for years and pile it into those 7 stocks because they're of the belief that they're rocket ships and they're just going to keep going up, 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 up. And we always learn our lesson the hard way by getting over concentrated, whether it's individual stocks or whether it's a hot index. Likewise, people learn their lesson over the last 2 years not to abandon an asset class, right? So the big loser in 2022 was the NASDAQ 100, lost like 35%, somewhere north of 30, depending on dividends. And then the big winner this year is the NASDAQ. So, the smart thinkers, all January 2nd said, you know what I'm going to do? I'm going to get out of this NASDAQ. It's going the wrong direction. And I'm going to get back to, a more conservative approach. And what you did was you sold the year's greatest investment. So we just want to stick to owning everything. It's that big pizza pie that's got a little bit of pepperoni and a little bit of veggie and a little bit of white truffle and all mixed together. There I go, back on pizza already.
And then coming into the end of the year, the holiday season here, we're hearing a lot about Santa Claus rally, all these up days recently. Santa Claus rally is coming early. We're going to get it before Thanksgiving. The consumer's already out on the trail spending. And for those of you that don't know, the Santa Claus rally is one of the many ways people try to time and predict the stock market and think that because everyone's out spending and buying gifts and using Amazon to get 7 different deliveries to their door for the various gifts that are coming out, that the earnings are going to be much higher and revenue is going to be much higher in the fourth quarter when they report next year. And stock markets anticipate that and try to go up. But I think there's tons of them out there, John. You could probably name some more too, but winner of the Super Bowl and sell in May and go away because nobody's gonna.
Yeah, the Super Bowl one was a lot of fun. So that was the theory that if the AFC won the Super Bowl, dump your stocks. And if the NFC won the Super Bowl, buy stocks. And the problem is it worked for a lot of years. And then I think that for some reason, I think it was the year the Broncos won 2 Super Bowls with Terrell Davis and Elway, that the market had great years. And everybody said, all right, scrap the Super Bowl theory, so people dial into things emotionally, and it's the reason that there are financial advisors, because we kind of separate the noise from a reality. Or as Jim Bowen likes to say, one of our mentors, is shred the narrative. You turn the news on, you're going to get a narrative. The earth is going to shift on its polar axis, and the only thing that will protect you is physical gold. Well, guess what? If the earth shifts on its polar axis, we're now the North Pole. I'd rather have skis and heating equipment, but we'll see.
And I think you bring up a good point there with gold, because we're hearing that a lot right now with a lot of the fear that's being dialed into the market, with the talks of recession, with the talks of, oh, what if the dollar goes away? And I think too many people get honed in on the fact that gold is a physical asset, and they don't really think about what an actual stock is and what goes into a stock and where its value comes from. So just like in real estate, which people say, hey, it's a physical asset, it'll always be there. They say that, okay, well, what's real estate derived in? It's derived in dollars. If you go buy a real estate transaction here in the US, you're going to have to pay dollars for it. Or if you sell, you're going to have to pay dollars for it. It's the
I
same thing
like that.
with a stock. A stock has a bunch of different underlying things that contribute to its value, including its earnings and its revenue, but they also have patents that add to their value. They have their own physical real estate. They have their own balance sheets of actual physical money. That some have their own gold even. So I think people get too tied into the narrative that stocks are just some traded investment that's floating out there in imaginary land and it doesn't really exist. And they're not realizing all the things that actually contribute to the value of a real stock.
Well, Taylor, though, when you think about it, people pay 20 to 30% for silver or gold transactions on both sides. So there's a great incentive to scare people with gold commercials, right? Because hey, you know what? I mean, I get the link all the time because I buy a lot of silver, and a lot of clients know I buy a lot of silver. But I'm getting links now for $30 silver pieces, and silver's under 25. And so that's a 20% markup right there. And then that's to buy it, right? And if I turn around and wanted to sell it, somebody will say, yeah, we'll give you 19 or 20 because and they're going to sell it for 30. So the spreads are phenomenal for that space. And then I want to add one more thing. You mentioned real estate. So you have a title to a property. A share of a stock is a title to that company. That's all it really is. Think about it as owning a title. And then, like you said, you own all those underlying things. I won't repeat them all, but you own all those things that come with that business. It's a business. So if I own a bagel shop, I get up in the morning and I own ovens and I make bagels and I do it for revenue and I have a job and I have employees. I can walk proudly down the aisle and say, that's my Crest toothpaste there. I own that company.
Yeah. And I think that's a big point there, is that just because you're not physically in there doing the management of the company and there's a management team in place, it doesn't mean it has any less value.
Yeah. I know this was driven to be an economy podcast, and we're going down the rabbit hole of assets, which I think is good because it's what we're hearing all week, the last 10 days from people. But the question, Taylor, you asked me is, are oil prices continuing to rise, or are they going to go or back up to where they were last year? And I would broaden that question that we get to about rising prices in general. So give us the oil part first, and then I'll go over the cure for high oil and high everything.
Yeah, so I think the big problem with oil is that everything gets shipped around. Everything we really use and buy in the US, most of it is imports right now rather than exports. And that's part of our economy, and part of the direction we've headed recently is made in America isn't really as common of a thing just because the price of goods. The problem is everything has to ship around America. So the big thing with increasing oil prices we're seeing is that when you have to ship something from Detroit down to San Diego, or from San Francisco over to Atlanta, you're looking at really expensive and increasingly expensive shipping costs that are going to get passed along to the consumers. So as oil prices continue to rise, it kind of exacerbates some of the inflation problem because of the fact that you have to pay to ship it across country.
Yeah, and people forget oil was in the 20s back in 2020 and early on in COVID, and then it was 123 last year, and then it's I looked this morning, West Texas was 76 and Brent was 81. So we can't get tied into this because, as I always like to say, the cure for high oil is high oil. And the reason is when the price gets really high, everybody says drill, drill, drill. All the companies start bringing oil to the market because they say, I got to get a hold of this and start selling $123 oil. That's what they did last year. So they flooded the market with oil. What happened is it can't get used up in time. So now the solution is, we're stuck with the oil. We better slow production down because we got a glut of inventory here. We got to wait for people to buy it. And there's too much oil, so people aren't buying it now. The price is back down $50. I saw it with timber. People might forget, but at the very beginning of COVID, there was this huge timber shortage, and a piece of plywood went from $11 to like $80. It was 8,000% or 800% increase in plywood. And if you're a timber company, you're saying, God, this is great. We could make a fortune. Let's cut, and you bring in overtime people, and you cut, you flood the market, and then all of a sudden, every other timber company did the same thing. And now Home Depot's like, no more. We don't need any more. And now they got to start warehousing what they cut. And Home Depot's got it in piles behind the building. This is like 2021. And all of a sudden it went from 80 to 60 to 50 to 40. And so the cure for high timber was high timber. And the cure for low timber is low timber, right? Because if it's too low, everybody lays everybody off. They stop the mills, shut down, and wait for prices to get better. And then the Home Depot says, we don't have enough timber, and we got to start getting more timber in here. And so that low price solves itself. They raise prices again because they're running out of timber. It's scarce commodity or abundant, and it works with apples, and it works with computers and washers and dryers and cars and everything else.
Yeah, and I think to that point, it's really the economic issue here that we're talking about is inflation. I think the other point that is pretty important to this conversation is the money supply and what else affected the inflationary environment that we're in and how did we get here. And during COVID and during the shutdowns, there's a lot of money going into the market getting poured in to make sure that the economy would stay afloat. And that's what's called M2 money supply. And it was everywhere, and it's still in propping up the economy, which I think is probably a big part of why we haven't had a recession yet, even though we're really due for one. So that kind of segueing right into the next question of, do we think we'll experience a recession here? And is it going to be a shallow one, or how's that really affected? And what are we looking at here, John?
Okay, so I've successfully predicted 11 of the last 5 recessions. Let me repeat that. I've predicted 11 of the last 5 recessions, which means I've been wrong at least, that many times. So in other words, when I predicted the 2023 recession in 2022, I've got about 7 more weeks for that one to come to fruition. So I don't think it's going to happen. My guess would be it's going to be more like the end of 2024. I was thinking it's going to be severe, but now I think it's going to be mild. I just traveled again a week ago, and the consumer is hanging in there. I think it's going to be much more one of those wave recessions where we get, first we get it in, home supply centers, and then it moves to, healthcare, and it moves through the cycle of different businesses. And so it may be a little longer than normal, but less painful. So that's my take. But either way, Taylor, I would segue to you and say, should we change our strategy completely because we're having a recession?
Yeah, and I think that's the big thing that really where we come back into play and where we start talking with clients. And I think a lot of people get short-minded in the sense that a recession is happening right now, or all my assets are at risk, or what portion of my assets are at risk. And that's when we look into having more of that bucketed approach where we want to split up assets, and assets that you need over the short term are covering any income that you need, or if you're still working, you really don't have to worry about because your income isn't really derived from your portfolio assets at that point. But making sure you have the assets you need to live off of to extend you through the recession and be ready for when a recovery comes. So I don't think personal goals need to change. I think it's a good time to buy on sale. I think a lot of people forget that the economy is separated from the actual stock market. As much as they kind of work in lockstep at times, people forget that the stock market is typically a leading indicator of what is actually happening in the economy, because people start to see the recession coming. And that's a lot of what happened last year in 2022, is everyone saw a recession coming and they all sold off. The recession never came. So the stock market went down, but we haven't had a recession yet. So now everyone is still saying, well, we're due for a recession. We're due for a recession. stock market should go down further, but a lot of that may have already corrected itself and already priced into the market. Not to say that there's not more to price in still, and depending on the severity, whether it's mild or extreme, it's going to price accordingly as well. But again, they're not the exact same thing. So looking at the recession and saying there's going to be a recession, which means my stock prices are going to go down or the bond market's going to go down, isn't exactly an accurate statement. And people shouldn't really focus on that or focus on changing their goals unless their actual life dictates it, not the stock market. You should be in control of your own goals and your own life and not let the stock market control that. Will help you match up your investments to achieving your goals, but that doesn't need to change because of short-term news or short-term recessions.
Yeah, that's great. And I would say that, that piece that we were talking about this morning from Dave. Dave is a senior portfolio manager for a fund company. We had lunch with him about a week ago. And actually, we didn't have lunch with him. We had lunch with each other, and he addressed the 40 planners in the room. But I have the piece, and it's a shareable piece, and his data that he put out this week reinforced what he told us that day. Of like the last 15 recessions, the 6 months before the recession, the stock market went up most of the time. And during the recessions, it went up most of the time. And that's reinforces your leading indicator, Taylor, that we had a bad year in 2022. We had a couple of bad months in September and October. That may be behind us. That may have shaken the loose fruit, from the tree and made things a little more normal. I don't know for sure. I know there'll be some parts of the economy that still go down during a recession and some stocks, but don't just think you've got it figured out. Okay, the recession starts today, we sell today, and when we get the announcement on the 6 o'clock news that the recession ended today, we buy that day. If that's the case, you're never going to get it right. Instead, we put the long-term money in the long-term bucket, and we put the short-term money and safety, and never the twain shall meet, as they say.
Yeah, and I could tell you across our book of business, there's a lot of money in areas like T-bills right now because they're paying north of 5%. And I think to that point is what money can flow into the stock market. And right now, there's something called TINA. There is no alternative. That was out there for a while when interest rates were low and you really couldn't go anywhere to get the actual outcome you need for retirement if you weren't in stocks. Now there is an alternative with T-bills. Interest rates are high, bonds are paying more. So there is an alternative which caused a lot of the money to flow out of the stock market temporarily. But I think as interest rates start to come back down, you don't want to be too late getting back into stock type investments because by the time interest rates come down a point or two, it's probably going to be too late. You're going to miss quite the rally in stocks already.
Excellent. Most people say to us things like, I thought you guys didn't like bonds. Like when we tell them it might be time to put that money in a bond, I said, you were right. I didn't like bonds when bonds were 1%. But the fact that we can get, 5.5% for 1 year and you need the money to buy a car in 1 year, why would we do anything else? We're going to match that asset to that liability. I need $40,000 for a car in 13 months. We'll buy a 12-month T-bill. We'll put it in your checking in 12 months. With the 5% interest, and you'll go down and buy the car then. And so again, that's strategy more so than liking different asset classes during trying to pick a hot asset class.
Yeah, and thank you guys so much for tuning in again today. That's going to be all we have for the day. Again, if you have anyone that you think this would be of interest to, feel free to share with your friends, family, if you think that they would benefit from this. So thank you for watching Financial Tides, and we'll see you again shortly.
John Parrillo and Taylor Parrillo are financial advisors offering securities through Cetera Advisors LLC, a registered broker-dealer, doing insurance business in California as CFGA Insurance Agency LLC, Member FINRA/SIPC. Advisory services offered through Cetera Investment Advisors LLC, a registered investment advisor. Cetera firms are under separate ownerships from any other named entity. California insurance licenses number 0F60123 and 0M90666, 6265 Greenwich Drive, Suite 251, San Diego, California 92122. The views depicted in this material are for information purposes only and are not necessarily those of Cetera Advisors LLC. They should not be considered specific advice or recommendations for any individual. Neither Cetera Advisors LLC nor any of its representatives may give legal or tax advice. Investors cannot invest directly in indexes. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and the fees and expenses associated with investing. Past performance is not an indication or guarantee of future results. A diversified portfolio does not assure profit or protect against loss in a declining market. The return and principal value of stocks fluctuate with changes in market conditions. Shares when sold may be worth more or less than the original cost. The return and principal value of bonds fluctuate with changes in market conditions. If bonds are not held to maturity, they will be worth more or less than the original value.